welcome to IPO Review. Today we are going to talk about forthcoming IPO of Campus Activewear, the initial public offering of sports and athleisure footwear company Campus Activewear will remain open from April 26 to April 28. The offer comes with a price band of rupees 278 to 292 per share. It's purely an offer for sale of 4.79 crore equity shares by promoters and existing shareholders. Joining me now to talk on the IPO is Mr. Nikhil Agarwal, Chief Executive Officer, Campus Activewear, and Mr. Piyush, Chief Strategy Officer, Campus Activewear. Welcome, Mr. Agarwal and Piyush to the show.
Thank you, Geetu.
My first question is for Nikhil. Nikhil, tell me, why do you think it's the right time to really go public? What is the main objective of the issue and the vision that you carry for the company?
So Geetu, see, for us as a family, the number one reason would be to carry on the legacy of our chairman. He's been the founder of Action. So what he's created in Action shoes, which we all know, it became the number one top of mind brand in the 90s. We expect to carry on that legacy in Campus, and realize his vision. On top of that, we are a brand, a consumer brand that has been very widely loved and received very well in India. Right, our consumers know us very well. They understand the product. They love the products. So, given the success that we have had in the market as a brand, we expect to replicate that into the investor community now. We hope to replicate that. And we would love to create value for now, hopefully the millions of shareholders or stakeholders that we're going to have in the coming times, right? So that's primarily the objective from our side.
Mm-hmm. Piyush, tell me, Campus has nearly 15% market share in the branded sports and athleisure footwear industry. Now, how do you intend to carry this forward? I mean, you have a good market share as of now, but there's a growing competition that we are seeing. We are expecting that India would grow at a CAGR of 8% by 2025. What rate do you expect your company, Campus, to grow in next 4 to 5 years?
Great question, Geetu. So if you look at the footwear industry per se, it's one of the most exciting spaces to be in the overall India consumer discretionary space. And within footwear, sports and athleisure is by far the most promising space to be in because it has not only grown at a decadal CAGR of around 16 to 18%, it is expected to further grow at a CAGR of around 20 to 25% from here on for the next 5-7 years. Now, being a dominant player in this industry, obviously we'll be the biggest beneficiaries of the tailwinds that we are seeing all across the spectrum. Specifically, shift from unorganized to organized or unbranded to branded play in this segment. Given people have started spending more and more towards their own personal well-being, COVID being a big trigger for that. Formal as a category is getting substituted by sports and athleisure in India, because back to office is no longer the same for us. We all want all-day, multi-purpose wear, comfortable shoes, be it in homes or be it in back to office. And again, health and wellness and proclivity towards sports has been at an all-time high for us. Needless to say, the unsatiated consumption demand coming in from the aspirational middle class of India is also fueling this industry. So these tailwinds are not only helping the industry grow at around 20-25%. Being a market leader, we are at the forefront of this growth curve. And this has been validated by our decadal growth CAGRs of around 27% for the last 10 years. And we believe that with the kind of product value proposition, the unit economics and the brand value that we offer to our end consumer, we'll be able to sustain those growth levels. And hence, despite the fact that we already have 15-17% market share, we'll be incrementally gaining market share in an industry which is ever expanding and holds all the promise for the near medium term.
But if you talk about this industry as such, it's highly competitive, Nikhil. We have lots of international brands, luxury brands entering the footwear market in India. How do you see your company meeting all these challenges? Because we have become very brand conscious now. Price doesn't matter to us as it used to be, say, a decade ago.
Sure, Geetu. So see, it's very interesting actually to note that, all the high decibel brands that you can think of like Nike, Adidas, Pumas of the world, right? They're all actually MNC brands are mostly saturated in these we call it the premium plus category, which is 3,000 plus rupee segment. Now in that segment, that's only an 80 that's only a 13% of the market, right? It's a very small niche market in India. India is primarily a $10 to a $50 sports shoe market, which is basically 500 rupees to 3,500 rupees. And that's exactly the price point in which we operate as campus. And we dominate this market. So there is no one true blue competitor really for us in this price segment, which is like the bulk of the market, 87% of the market. Now, why we've been able to scale up like this, Gitu, and why there is no other competition is that we are the only brand that we're a single category focused brand, like very akin to the likes of Anta leaning in China or Nike, Adidas, globally. Even those giants across the globe have been able to scale up because they've always been single category focused. When you look at multiple category focused brands, which are there in India as well as globally, they've not been able to scale up every single category. You have to own one category as a DNA of the company, right? And that's exactly what we have done. We have never ventured ourselves out to any other category. We've always stayed true to sports and athleisure footwear brand.
What about your manufacturing facilities? How many of them do you have currently, and what is the kind of capital expenditure that you foresee for the company, say, for expansion, for catering to the newer markets?
So currently we have 5 manufacturing units. Okay. We have a capacity of 25.6 million pairs, which is by far the largest in India, almost by a delta of 4 to 5x, with the second largest competitor. Going forward as well, Gitu, this is not exactly a very capex intensive industry. As a thumb rule that we follow, we need to invest about 100 crores of capex to achieve revenues of about 5 to 600 crores, right? So the asset turn for us is about 5 to 6x. And another 100 crores we need for working capital. So basically with a 200 crore investment, we can generate 5 to 600 crores of revenue, which would translate to about, let's say 110 to 120 crores of EBITDA. That would give us the ability to deliver ROCEs at 50 to 60% on a full utilization basis. Right. And that's how we look at our industry. And so it's not exactly a very, for a brand like us, it's not a very capex intensive issue. It's more of human capital and supply chain issue, which we have basically perfected and grown over the last several years. The supply chain network to be able to provide the right, design at the right quantity, in the right channel at the right time. It's a very complex equation to crack, which we have successfully done in the last couple of years.
Piyush, what is the current debt to equity ratio and the net cash flow situation on the books?
Gitu, our current net debt to equity is very, it's closer to 1:1. It's sub 1 as we speak, on the basis of our 9 months FY22 financials. And while the endeavor of the company is to repay debt and invest in working capital through the internal accruals that we generate quarter on quarter, and hence we don't see a lot of cash as of now on the books. But given the kind of structure we have, given the kind of franchise we have, and also the fact that it's not a very capex intensive industry, from here on we expect to generate a lot of cash. So all our future expansion endeavors also, we believe we should be able to fulfill using our internal accruals with the right mix of debt to equity going forward as well.
Nikhil, inflation is a concern now for everybody. I mean, they're rising input costs, raw material cost. So do you have the pricing power to really, cater to the segment in India? Prices are inching higher. So will you be capable of, putting up the prices that you really would intend to because of the rising input costs?
Yeah, sure. So yeah, unfortunately, I mean, Gitu, inflation, has been a bummer for everybody across the globe for the last 2 years. But, what we have demonstrated in campus as well, if you look at our track record, we have successfully passed on all of the inflationary price increase that has happened specifically in the last 2 years. in the form of MRP increase. So starting at 50 rupees increase in the economical range and going up as high as 250 rupees in the more premium side of ranges. We have successfully passed on, and not only have we passed on, we have grown our volumes significantly. So we sold 13 million pairs in FY21, which was also in only 7 months of operations. In FY22 till 9 months, till December, we have sold north of 13 million pairs already in 9 months. Right, so we have significantly grown our volume in spite of passing on the MRP increase to the end consumer. So, and also another thing to note is, Gitu, that only 15% of our raw material is actually directly linked to crude. Right, so we don't have a raw material linkage to crude in that sense. So even if, let's say, crude moves up from $100 to $200 a barrel, our 15% component would basically double. So it would become 30% in terms of cost. So we would have to pass on, let's say, 1,600 rupees median MRPs that we operate. It would basically become 1,750 rupees as MRP in order to pass on $100 crude effect, to the MRP. So it's and that's, we have demonstrated that fairly successfully in the last 2 years from across the all the price points.
So do we expect another price hike in times to come in the near future?
I mean, while our endeavor is to give the best product value proposition to our end customers, and we try to ensure that with the cost optimizations and working very closely with our vendors in terms of indigenization of our supply chains, we ensure that such events should be limited to once or twice in a year. But see, if price inflation becomes a reality of the industry, then like the rest of the industry, we would also have to think of disseminating it across the value chain.
Since, Nikhil, you are going for price increase, do you expect demand to get dented to some extent because of the price rise?
So, Gitu, that's a very interesting question. So the kind of price elasticity we enjoy across the pricing spectrum that we operate on, starting, say, from the entry level, where it goes up to 50 to 100 rupees, right at the other extreme on the premium side of the portfolio, where it goes as high as 350 to 400 rupees. Given the kind of raw material basket that we have for our shoes and the kind of value addition we do, whatever inflationary effect comes in, it's so far it has been contained within the price elasticity that we enjoy at various price points, and hence disseminating that price increase to the end consumer doesn't really impact our volume of takes. And this is something that we have demonstrated successfully over the last 2-3 years. So hopefully inflation levels would be contained within a reasonable limit. Some bit of inflation is somewhat good for us also, because it helps us in gaining a little bit of market share, just to be candid around that. But yes, we do hope that inflation levels would be contained within the country, and we will continue to offer the best product value proposition to our end consumers in the near medium term as well.
Nikhil, one last question. Cost of funds are expected to rise because now we expect RBI to act and increase interest rates, which is in turn going to increase the cost of funds for every corporate, not for campus only. So how do you foresee the future in terms of cost of fund rising for corporate India?
It should not really impact us too much, because we'll be generating significant amount of operating cash flow, from starting from next year, starting from FY23. So there should be no reason for us to be worried about cost increases in terms of interest rates. While we do have some debt for this very specific reason, that debt today in India is quite attractively priced, and some bit of debt in very moderate amounts is a good healthy mix to maintain. But certainly we're not worried about interest rate hikes really as a brand.
Thank you, Nikhil. Thank you, Piyush, for your time. It was lovely speaking to you guys, and wish you all the best for your forthcoming IPO. Thank you so much.
Thank you so much, Gitu. Pleasure talking to you.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.